Hello and welcome to Insurance in Canada. I'm your host, Rick Pineda. Thank you so much for joining me. On today's episode, we are looking at three articles. The first one looks at the possibility of small businesses seeing increase in their premiums, insurance premiums in the near future. Our second article looks at Ontario's plan to scrap speed cameras and the possible insurance implications for this. And our last article will look at, even though insurance companies have been trying to install convenience features to try and get claims settled as possible, there are hurdles in insurance companies trying to settle those claims quickly. So without further ado, let's take a look at insurance in the news. So our first article today looks at the possibility, at least in Ontario, of small businesses seeing steep increases in their insurance premiums and why this might be. And even though it's Ontario focused, it could have implications for businesses in other provinces as well, because as premiums go in Ontario, it does indicate a trend in other parts of Canada as well. So let's take a look at this article. Ontario small businesses face steep premiums and shrinking insurance options. Small businesses in Ontario face sharper premium increases than mid-market firms, says Russell P. Philpott, Executive Vice President at Stabler Insurance. And we have talked about in previous episodes the soft market in commercial insurance that's still currently going on. However, it's not in all aspects of commercial insurance that is experiencing that soft market. There are some aspects of commercial insurance where premiums haven't gone down the way other sectors have gone. And small businesses are probably one of those, depending on what type of small business we're talking about. That's one type of commercial insurance where you haven't seen that drive to obtain that type of business, depending on what, like, once again, depending on what type of business we're talking about, or seeing renewal decreases on that type of business as well. Back to the article, from a small business perspective, we certainly see a larger percentage of rate increase year over year in that space than we would in mid-market, he said. While the actual dollar amounts were smaller, the percentage impact was heavier. Larger firms often outgrew their premiums as revenue expanded, meaning insurance costs represented a smaller portion of their business. In contrast, companies without scale absorbed increases that eroded profitability as premium costs made up a greater share of their overall expenses. That pressure was made worse by what Philpott described as a split marketplace. Our insureds are in the bucket of being highly desirable and highly sought after from an insurance provider, or the opposite of that, and it's a struggle to find them offers, quotes, coverages, he said. With few competitive forces at work, owners had little room to manage costs. Raising deductibles once a standard option offered limited relief. They're just oftentimes seen as not worth it, he said. For some, the only option became cutting back coverage, an approach he said he described as a very risky endeavor that starts to be a good money after a bad type of paradigm. And yes, that's true. Raising deductibles once seemed to be the go-to option to try and, entertain with the client lower premiums, besides going any other route involving reduction of coverages. But yeah, what the article is mentioning these days, even seeing, for instance, if a commercial policy has $1,000 deductible, increasing to 2,500, you might see a $30 a year annual decrease in the premium to increase the deductible by 1,500. It's going to take decades for someone to try and make back that savings compared to the increase in the deductible. So it was the go-to option. Sometimes it is, sometimes it's still viable, but it's not as good as it used to be. Back to the article, affordability challenges have shown up in rising cancellations, particularly since COVID. Stabler tracked a jump in first-year cancellations, often linked to non-payment of premiums. We normally take that as an indicator about affordability, because normally a forced first-year cancellation is driven by a non-payment of premium. We've seen those rise pretty significantly post-COVID. Philpott says, yeah, that's pretty accurate. You don't see it's either going to be non-payment of premium, or if it's going to be cancellation from the insurance company side. First year, non-payment of premium, or something hasn't, some underwriting requirement that the insurance company requested has been complied with by the insured. But during the first year, yeah, the vast majority of cancellations by the insurance company is going to be non-payment of premium, especially those small business type of policies. The cycle quickly became self-reinforcing. If you've got those cancellations for non-pay, it's going to further restrict your options. He said, yeah, that's true. If you got a commercial insurance, if you have a cancellation for non-payment, good luck. You are seen as poisoned by other insurance companies. So at least the standard insurance companies. So non-standard market, if you're lucky. If not, then your business is not going to be able to be insured. Uh, getting cancellation for non-payment on a commercial aspect, you are seen as a moral hazard, that you are not financially stable, and insurance companies do not want to insure moral hazards. Carriers often, now getting back to that, yes, there's always extenuating circumstances. Could have been a bank error, could have been something like that. But without those extenuating circumstances and trying to convince the insurance companies that those extenuating circumstances do apply, yeah, they're going to be seen as poison by insurance companies. Carriers often remove monthly payment plans, required premiums in full, leaving businesses stuck with less choice and more financial strain. It is a bit of a negative cycle there, where they're in a financially tricky situation, and it's made worse by less market choice and fewer payment options. Climate pressures have added another level of difficulty. Water deductibles, sewer backup supplements, and temporary moratoriums during wildfires or severe weather events have become more common, narrowing projection just as risks were rising. Philpott also pointed to reduce insurer capacity across commercial lines. Subscription policies, once a fallback solution, have become harder to arrange. We have seen a bit of a reduction in capacity. In a lot of cases, he said, the more traditional solution for that problem is also kind of going away. True, but then again, when we're talking about small businesses, you don't usually see too many subscription policies. Subscription policies where you have more than one insurer insuring a particular risk, and each insurance company's insures for a particular percentage that's all indicated on the subscription page. But for many small business insurance, it's usually just one insurance company that's insuring uh, the entire risk. Usually subscription policies is more complicated policies, more larger policies that one insurance company doesn't want, unless it's a program that a managing general agent has created. But for your average small business commercial policies, usually it's just one insurer that's usually tackling that. Cyber insurance carries its own hurdles. Many small firms cannot meet the upfront requirements around multi-factor authentication, encryption, or data backup. From an SME perspective, cyber challenges for the insurance product are usually underwriting requirements in order to be qualified for quotes. Philpott said, even when coverage has been available, terms have tightened. We've seen some policies that have modified their definition of data. If that information is not being sufficiently backed up or encrypted at the time, it won't be considered as part of the data in question under the policy. Automation in underwriting offers efficiency, but also shut doors for firms that fall outside standard parameters. Some of the increased automation and technology in the small business space just kind of leaves you in a paradigm where either it fits the boxes that we're checking on the screen or it doesn't. And if it doesn't, then it's usually a decline. Philpott said systems were not always able to account for context. Sometimes they can just make a de facto assumption that any claims are indicators of behavior and indicators of future claims happening again, regardless of the nature or details of that claim, he said. Looking ahead, Philpott warned the real issue was not simply new risks, but the loss of coverage altogether. I would frame it not as much of a coverage gap per se, but more of a coverage availability gap, he said. The industry's instinct had been to move quickly to exclusions. There is sort of a posture, it seems, that when these new emerging risks come in, they are excluded rather rapidly, he said. Communicable disease exclusions for COVID and broad forever chemical exclusions show how fast protections could vanish for businesses on claims-made policies. The consequences have been even harsher, even if an insurer is only adding exclusion now in light of something new. If you're on a claims-made policy, that can effectively mean that you never had the coverage in the past. So there's a lot of interesting points to take away from this particular article, but keep in mind when it also going to be depending on the type of business we're trying to insure. There's a lot of standard businesses, such as think a retail, like a bakery, that most insurers, as long as they have the proper fire protection, that most insurers would look at. But there are other small businesses. For instance, a consulting firm that does consulting work, for instance, at a construction site for safety. That can be, even though it's a small business as well, maybe they have revenues of $100,000. That's a typical small business, but that can be a much more complicated type of business to insure just because of the consulting type business. So, unfortunately, for small businesses, insurance costs can eat up a large percentage of their expenses, annual expenses, depending on what type of business we're talking about. So, unfortunately, it's the type of news that small businesses, especially with the tariff situation that's going on now, that's probably not the news that they were hoping for, but we'll see in the future how this actually plays out. Our next article looks at Ontario's plan to eliminate speed cameras and how that could affect insurance. I don't necessarily agree with a lot of what this article is insinuating, but I'd like to present both sides and have a look. Maybe there's something in the article that might change my mind, but I really question the effectiveness of speed cameras, whether that's going to really change behavior when it comes to those type of drivers who really don't take other people's safety into account. So let's take a look at what the article has to say. And speed cameras not only in Ontario, there's other jurisdictions, other provinces and territories that use speed cameras. Some do, some don't, but Ontario is planning. The provincial government has announced that the plans is to eliminate that in the province. We'll see how other provinces react to that. How Ontario's plan to scrap speed cameras could raise insurance premiums. Watch for auto insurance rates to increase if Ontario proceeds with its plan to remove speed cameras. A property and casualty insurance industry exec predicts if municipalities become riskier and there's more accidents or more records of drivers being pulled over, it could have a longer term effect on how certain areas are rated and could increase the price of insurance, says Matt Hans, Vice President of Insurance at ratehub.ca. More directly, if there is more police presence out there and more people getting pulled over by police, it will have an individual impact on the drivers themselves. Ontario Premier Doug Ford announced earlier this month his government will soon introduce legislation to ban the use of speed cameras, calling the enforcement tool a cash grab. But over the long term, removing speed cameras could end up costing drivers just as much or even more through insurance premium increases, says Hans. If you repeal the ability to use speed cameras, you're going to add more risk. You're going to have more accidents. There could be catastrophic losses. And if that's the case, that's when you're going to see the impact on insurance. He says overall, it could affect the rating algorithm. That's a statement I have to call into question. He hasn't really presented any evidence to indicate a causal link between removing speed cameras and increasing in frequency or severity the type of accidents. I mean, they were predicting that when Doug Ford announced certain highways would have their speed limits increased from 100 to 110. The QEW Niagara, from Niagara to, not Niagara, but St. Catharines to Grimsby is an example of an area where the speed limit was increased from 100 to 110. I haven't seen any evidence to indicate that accident frequency or severity increased due to that action. So if you can't make a causal link between increasing speed limits and increase in accident severity or frequency, then I'm not sure how limiting speed cameras is going to do the same thing. So, I mean, speed cameras only monitor a very small section of the road to begin with. And once drivers know where these speed cameras are, I mean, they'll reduce their speed, from the time they enter in the observable area for the speed camera until the time they leave it. So what about the rest of the road? Is there more accidents taking place in the rest of the road as opposed to that particular area? I haven't seen any evidence to that. So let's see what the rest of the uh, article has to say. Ford's proposal for more traffic enforcement via an increased police presence could have a material impact on an individual's premiums, Hans says. In comparison, drivers who receive a ticket from a speed camera won't see that impact on their insurance, and that's correct. If you receive a speed camera ticket, that goes to the owner of the vehicle, not to the driver. Being pulled over by police for speeding, that ticket gets handed to the driver. It gets assigned to the driver, and that shows up on their moving violations record. These speed camera tickets do not show up on moving violations record because, as I said, those tickets go to the owner of the vehicle who might not have been the driver at the time. So that's why they do not go on moving violations record. So if those drivers who are receiving those tickets or triggering those tickets, if they're not seeing any consequences on their insurance for speed camera tickets, then where's the incentive to slow down? So same thing goes with red light tickets, red light cameras. Those also do not impact insurance because they get assigned to the vehicle owner, not the driver. If you physically get pulled over by a police officer because they can identify you, the ticket is actually attached to your record, and that will impact your insurance. One minor speeding offense issued by police could increase rates by 11% over 3 years, according to ratehub.ca data. Someone with a clean driving record, by comparison, would see no traffic offense-related increase. 2 minor traffic offenses, such as speeding and failure to yield, could increase rates by 52% over 3 years, possibly. That's that upper limit as opposed to what someone could typically see. And 3 minor offenses, speeding, failure to yield, and improper lane change, could increase by 119%. Possibly. Once again, upper limits. It all depends on which insurance company you're insured with and what the rest of your record looks like. Because if you factor in at-fault accidents as well into the mix, it could be even higher. RateHub.ca's analysis was based on a 35-year-old female G licensed driver, Mississauga. I'm not going to go through the details. If you get a ticket, it won't impact you that day, but where you would probably see it is on your renewal, or if you shopped around. He says not every insurance company pulls your driver abstract every year, so sometimes you might get a ticket and expect your rates to go up, but it doesn't go up that 1 year, then it goes up year 2. If an insured person gets a speeding ticket, they can take steps to reduce or eliminate the consequences to their premiums. For example, the driver can either fight the ticket in court or use a ticket fighting company, says Hans, which is the same thing, whether you're fighting it yourself or having somebody else do it for you. These companies help you go to court to fight the ticket. Yep, that can improve the impact of the ticket on your insurance premium at the very least. It can delay the premium impact because a ticket only goes on your driving record once convicted, which is true. However, a conviction is a conviction, and if you're being convicted of going 20 over as opposed to 30 over, it'll make a difference in the fine. It's not going to make a difference to your insurance premium because that's still a minor conviction. Once you get to 50 kilometers and over, that's now a stunt driving charge in Ontario and many other provinces as well, and that's a major ticket. And if you're with a standard insurance company and you get a major ticket, you're gone next renewal. That's it. Every standard insurance company, therefore you're going to the non-standard or the facility association, who's the insurer of last resort. You're going to the high risk market with that major. So getting convicted 50 over or getting convicted 48 over would make a huge difference on your insurance. But anything 49 over and below, it's not going to make a difference. Same thing with demerit points. Getting 2 demerit points, getting 0 demerit points on a infraction, it makes no difference to your automobile insurance. Demerit points is only used by the ministry to determine if your license should be suspended or not. It makes no difference to your insurance rates whatsoever. So some interesting points in this particular article. Like I said, without any scientific evidence to back up or studies or anything to back up what's being presented in this article. It's just one person's opinion, but it'd be interesting to see once this legislation is passed and the cameras are removed, if anybody actually conducts a study to see what the ramifications are for removing the red light camera in terms of accident frequency and severity. And our last article looks at insurers' reluctance to settle claims quickly. Like I said at the beginning, insurance companies do take steps these days to introduce technology to try and expedite the claims process. However, there are some things that are throwing a wrench into the works in terms of trying to get these claims settled as quickly as possible. Insurers more reluctant to settle claims quickly due to ongoing price volatility and post-catastrophe repair backlogs. Insurers are taking a more cautious approach by waiting to see where repair and rebuild costs for property losses actually land before finalizing payments, experts at the Canadian Independent Adjusters Association's Claim Summit said on October 3rd. But strategies exist, from offering Canadian-made repair materials to pre-loss supply chain mapping to help insurers overcome service delivery hurdles after property losses, panelists said during a discussion about tariffs and international trade barriers. And I would imagine that most insurers would rather go with the Canadian-made repair materials. I'm not sure. I mean, as I always find it amazing how Canadian products seem to cost more than products being imported, the exact same type of product being imported into Canada. But I imagine when it comes to Canadian-made repair materials such as drywall, lumber, even if it does cost slightly more, I imagine that most insureds would see that positively, that their insurance company is offering those options. Back to the article, ongoing price volatility from rising construction materials, increased labor costs, and other factors make it risky for insurers to agree on settlement amounts too early, but that's dragging out repair timelines. From the adjusting side, insurers are more reluctant to settle, said Michael Galea, Vice President of National Operations at Sedgwick, Canada. We just got off 4 cats last summer. It was a busy year. So when you're waiting a year or 6 months to get your house fixed, that's a long period, and things can change in those 6 months, he said. Insurers are coming up with different ways, settlements or supplements, to make that gap. Some insurers have been employing cash settlements to pay out the property damage instead of managing repairs to completion, but that comes with its own customer satisfaction risk, and I totally agree with that sentiment. Most insureds do not want to be their own general contractor to try and fix the damage that was done to their house. They want their insurance company to take care of this. So trying to push the cash settlement option on many insurers is going to rub them the wrong way, because they're going to be, some insurers might see that as the insurance company trying to pawn off their responsibilities to them, as opposed to taking care of the situation themselves. So yeah, that's a double-edged sword when it comes to insurance companies adopting that attitude, in my opinion. If you have a different opinion, let me know. Claims adjusters out there, let me know if you've had that experience with insurers when you try and go the cash settlement option, if you've seen any resistance to that. Obviously, every insurer is going to be different. Maybe there are some insurers out there who are more than happy to take on that responsibility themselves, but like I said, I would imagine that's more the exception than the rule. Back to the article. During a busy period, you're trying to close claims, and it's a balancing act because you're balancing that with net promoter scores, Galea said. Excuse me. Anecdotally, what we're seeing is if you make a cash settlement, your NPS score isn't as good as if you were see it all the way through. By helping customers make decisions quickly, like selecting contractors or approving repairs options early, insurers can lock in prices and availability before things change, said Sean Purcell, Assistant Vice President of National Property Claims at Aviva Canada. Purcell referenced Calgary's July 2025 hailstorm, where customers wanted to choose a contractor and start rebuilding right away. People were accepting of some of the Build Back Better features that we have, but they're like, I need the money. I'm going to go with this contractor. I need to sign up now, Purcell said. That is also where we're pushing Canada products first. He said it's all how we frame it with the customers up front so we can take that worry out. Frequent disruptions, stricter regulations, and cost uncertainty are leaving many companies struggling to map and manage their supply chains beyond the first tier of suppliers. Supply chain disruptions are creating longer times for settlement, and there's more uncertainty around forecasting costs, said Matthew Zuccato, Senior Vice President and National Leader of Strategic Risk at Marsh Canada. When we talk to our clients about what they are challenged with, the first is there's often a very large lack of visibility in their supply chain. They're blind to a lot of risks, anything beyond the top one supplier level, or they're going through a painstaking and costly analysis to determine what that supply chain looks like. And they're facing cost disruptions. To address this, insurance firms can turn to tools that use AI and shipping customs data to reverse engineer supply chains from top down. So starting with a tier 0 and tier 1 information, you can look down to the tier 2 and tier 3 levels, says Zuccato. That really helps in a number of ways. Supply chain mapping can identify concentration risks, natural hazard exposures, sanctioned geographies, and other potential bottlenecks such as multiple suppliers depending on a single low-tier manufacturer. The supply chain mapping process happens pre-loss, says Zuccato, but it's about helping build a more resilient supply chain and ensuring there are lower costs and the lowest timelines possible. So it's always going to be a fine edge with insurance companies when it comes to trying to reduce loss costs. However, you have to also look at the insured's perspective as well. They are expecting service for the service that they purchased. So trying to find that balancing act is always going to be tricky. Hopefully the adoption of these new technologies can help alleviate some of these issues, but I'm always going to say cost savings are nice, but always remember it's the insured that's paying your bills and paying you to stay in business. So no insureds, you have no loss costs, but you have no business as well. And that is it for me for today. Thank you so much for joining me. If you like what I do here, please leave a like. Please subscribe for more. Please leave a comment in the comments section about anything I talked about today. Don't forget to follow Insurance in Canada on X/Twitter. And until next time, bye-bye.